Be Wealthy and Smart, episode 1463.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about tariffs, inflation, and the stock market, because lots is going on, and they're blaming tariffs for this bumpiness in the stock market. But is that really the cause, or is there something else going on? So first we had the Chinese AI DeepSeek appear with a surprise, which drove a sell-off early in the week. But then on Friday, President Trump talked about plans for tariffs. On Saturday, he placed tariffs on Canada, Mexico, and China, which will be fully enforced by Tuesday, February 4th. There's going to be 25% duties on Canada and Mexico and 10% on China over issues of fentanyl and illegal migration. Now, stocks have been up strongly for the year so far, with the S&P in January rising 2.7%, the NASDAQ up 1.6%, and the Dow Jones up 4.7%, which gives us a positive January indicator. Not always accurate, but it helps improve the odds of a positive year in the stock market. Senator Eric Schmidt, Republican from Missouri, said, "I think these tariffs specifically are meant to bring Canada and Mexico to the table for the fentanyl that is streaming into our communities." He added, "The fact is, these countries are taking advantage of us all along while we've got fentanyl streaming into our country. So Mexico has a choice. They can choose to trade with the United States or continue to cozy up with the cartels. It's pretty simple." The criticism of the tariffs is to say that they will raise prices on Americans and make goods more expensive for the consumer. And on Friday, a personal consumption expenditures price index report came out, which is the Federal Reserve's preferred inflation gauge, and showed an increase of 0.3% from November and a 2.6% annual inflation rate. This was in line with economists' expectations, but marked an acceleration from last month's inflation rate of 2.4%, which is not moving in the right direction. We want to see inflation head closer to 2%, so the Federal Reserve is more comfortable lowering interest rates. Excluding food and energy, the core PCE increased 0.2% monthly and 2.8% on an annual basis. While there were a heap of negative predictions for the stock market this year, which I tend to think as a contrarian is positive, because they're usually wrong, one thing that tells us what's going on with stocks is to look at earnings, because ultimately earnings drive stock market behavior, and better earnings are what's going to make the market move higher. And while we're just halfway through the earnings reporting period, the S&P 500 is currently pacing for year-over-year earnings growth of 13.2% for the fourth quarter, which would mark the fastest rate of growth in 3 years for the S&P 500. This is higher than the 11.8% growth consensus had expected on December 31st. John Butters, FactSet senior earnings analyst, pointed out this reporting season has been a particularly strong one for companies that are surprising Wall Street to the upside with their earnings per share numbers. Analyzing the 2 days leading into and following a report, companies that beat Wall Street's earnings expectations have seen their stocks rise 1.5% on average. This is above the 5-year average of a 1% rise for companies that top earnings estimates. In other words, while noise about tariffs, inflation, and the overall path of monetary policy continues to dominate the discussion, the strong trend in earnings continues to be what's keeping Wall Street strategists bullish about the stock market outlook. Keith Lerner, Truist co-chief investment officer, said the most steady part of this bull market has been those earnings trends. Those forward earnings estimates every week are making new highs. All in all, we think the bull market trend is intact, supported by these earnings that are somewhat still underappreciated. Well, bottom line is earnings are what's most important, because that is ultimately what makes stocks able to be priced higher. And while we heard constantly for the last few years that we would have a soft landing, a hard landing, or a recession, none of those things really came to be. The market has trotted on very powerfully, and it continues that trend in spite of a lot of things being thrown at it, such as the Federal Reserve jawboning about interest rates and China launching DeepSeek over here. Today, the Institute for Supply Management will release its ISM manufacturing numbers, and the reading has shown the sector of manufacturing is in contraction for more than 2 years. But some people think the tide may be turning and manufacturing may be getting better. Any number above 50 shows that it's increasing rather than contracting. So we'll be watching closely to see how that number turns out today. And another key update this week will be about jobs. The January jobs report is due this Friday and is expected to show the U.S. labor market added 150,000 jobs in January, down from the 256,000 seen in December. Meanwhile, the unemployment rate is expected to hold steady at 4.1%. Stuart Kaiser, Citi head of U.S. equity trading strategy, said, "We think the unemployment rate is probably the single most important macro data point you're going to get every month. If you see a significant uptick in the unemployment rate, that potentially puts the Fed under pressure and puts the market under pressure as well. And should the number come in weaker than expected, the market will anticipate that, and we should see interest rates trend lower." So we'll see what happens this week when the data comes out. But so far, the market looks very resilient, very profitable, and in spite of a little bumpiness in price, able to shake most of it off. We'll continue to report back to you as this story continues to unfold. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.